Be Your Own CFO Part 6, a little bit more depth on the concept of liabilities. The simplest way of thinking about them is that a liability is something that you owe, like a credit card balance or a bill from a vendor or a loan. But the more technically correct concept is a little bit more interesting than that. A more correct definition is an obligation arising from past events that will require an outflow of economic resources in the future to settle. In layman's terms, if somebody did something or gave something to you and you're going to have to give up money or work to compensate for that eventually, there's a liability. So for example, a warranty can be a liability because you may have to do something to compensate for that warranty in the future. Gift cards are also a liability. Somebody paid you cash and you're going to have to give them goods in the future. Until you give them those goods, you have a liability. One of my favorite examples is deferred revenue. We'll cover it in more depth in the future, but I'll give you two common examples. If you sell a monthly subscription product and a person buys a full year up front, you don't recognize all that revenue right away. You recognize revenue for the first month, but the other 11 months are a liability until you actually give them the product. Another example is if you get 50% upfront for a project that's going to take 8 months to complete. A big portion of that will stay as deferred revenue until you've done the work. We'll talk a lot more about deferred revenue in the future, but part 7 is going to be about equity.